recipes for technical trading success in Cook's Kitchen.
Do you know what the #1 currency in the world is? Is it the US dollar, the euro, maybe the Chinese yuan? Neither. The #1 currency in global capital markets and financial markets is confidence. We learned that in 2008 when markets fell out of bed and we needed to restore business confidence and consumer confidence and get the banks back on their feet. Regardless of how you feel about bailing out banks, confidence became the currency. Could the government step in and restore confidence and optimism and stability, at least, for businesses and consumers? Let's do a deeper dive on the current state of investor, consumer, and business confidence and optimism. First chart we're going to go to is the State Street Investor Confidence Index. This is an actual survey of real allocations by fund managers from 45 countries around the world. State Street has been doing this for a number of years, and you can see, what's interesting about this one is that we had an earnings recession in basically 2015 into early 2016, investor confidence was still pretty high right into that, holding above 110, 120, which was bullish. And then the markets bottomed, let's say we'll call it, spring of 2016, but investor confidence was still making new lows. And I think this was sort of post-Brexit, so we had the Brexit vote in June of 2016, and then we get this late low into July, August in investor confidence. But now let's fast forward to where we are now. Look at here. So into the early winter stock market peak of 2018, investor confidence soared back up to levels we hadn't seen in a couple of years, but then obviously really fell out of bed into the October correction. And that's what you see here. Now, really, this was soft while the market was making new highs. That's the point I want to make. The market's making new highs in here in September, but this was falling. So that was a positioning clue right there. And I wish I had paid closer attention to it. Sometimes we have our favorite indicators and then we forget to look at them for a month or two. And this one was sort of a key tell that while the market was grinding higher, global investor confidence, major, significant money managers were growing less confident into that. I was bearish, but it just seemed like the market couldn't go lower. All right, let's take another look at institutional sentiment. Bank of America Merrill Lynch is very famous for something they call their fund manager survey. It's an extensive survey. I think they do at least once a month, and it has many components to it. But here's a recent exhibit, and I think this is inside of 10 days old. How do you think the global real economy will develop over the next 12 months? And again, this is of their large clients, their large investors, fund managers, and other types of institutions. And what do you see here? This is down to like levels that we haven't seen since 2009. I mean, this is amazing to me. I just saw this yesterday, and I could not believe it. That this is the large investor outlook for the global economy over the next 12 months is pretty bearish. So this is the net percentage expecting a stronger economy. Now, so let's sort of define that. What are they worried about? Well, they're worried about the fact that growth has peaked, meaning we've seen the best earnings growth and economic growth, and it's only decelerating from here, while interest rates are rising, while there's tariff battles, and you can think of a whole host of other macro reasons. There's this macro angst that I've been talking about to my followers that has fund managers selling into rallies. All right, let's keep going here. Another piece from the fund manager survey by BofA Merrill. What do you think will be the best performing asset class in 2019? And the managers are answering, you know, it's not U.S. stocks, it's not the S&P 500, it's outside the U.S. So, and I think this is a sort of a play on emerging markets have been so crushed, you know, it's a relative value trade that here we are, S&P still within, you know, 5% of all-time highs. So money will shift. You know, if you're going to make a bet, they think that U.S. equities could go sideways to lower while maybe money looks overseas for opportunities. And all these confidence and optimism charts I'm showing you are also in the context of real economic data in the U.S. also making new highs. If you look at leading economic indicators, that chart is just soaring. So why would institutional investors be selling into that? Well, because of all those macro worries we talked about. All right, now let's look at U.S. small business and the consumer. This is the NFIB Small Business Optimism Index. I love this survey. It has been a great tell for the strength of the economy. Look at coming out of the earnings recession of 2015, 2016. This thing really started to soar. Obviously, the Trump win gave small business a lot of optimism. We knew a big tax cut was coming, and look at it, stayed right up here. So this is the National Federation of of Independent Business, and so they do this Small Business Optimism Index survey. And what's great about this is it's very quantitative. They have 10 components that they ask small businesses. Things about, you know, expansion plans, hiring, you know, hours worked. Are you optimistic about your sales? Are you looking for loans to expand? All kinds of things that they can quantify and then put into this, you know, a diffusion index. All right. Now, what's underneath small business confidence? Obviously, consumer confidence. And it's just soaring, right? Consumer confidence looks just like the leading economic indicators. As you would expect, they go together. I don't know if you can see the retail sales bars on this chart. They should be vertical bars underlaid, because that's what Econoday does with their data. They like to show retail sales and consumer confidence working together, because obviously there is a correlation and a relationship. So consumer confidence, you can't say enough about that. All right, now we're going to talk about, we've talked about institutional investors. We've talked about the backbone of the U.S. economy, which is consumers and small business. Now let's talk about another group of investors that can tell us about sentiment, and usually as a contrarian indicator, because the Investors Intelligence is a great sentiment survey because it has such a rich data history. It goes back to 1987. And they've done things consistently, so you can always get a glance of the data going back 35 years and see typically what has the what has the market done when optimism reaches an extreme or pessimism reaches an extreme, and that's where you get a contrary indicator with this. So let's take a look. So and this data is as of November 6th. This week's survey should be completed by now on Wednesday, November 14th. We just don't have the data yet. It goes to subscribers first. I'll probably see it sometime tomorrow from Yardeni. But here it is, Yardeni presenting last week's data. And as I told my folks, I wanted to see the bullishness go down. So here we are. Find where I'm pointing. Okay, so this peak, this was the early 2018 peak that I said, hey, be very cautious. This market is way too exuberant. That's when the Dow just rocketed higher in early 2018. So that was our first correction. So what have we done since? We've sort of chopped around here between 2.25, 3.25 bulls to bears in the ratio, meaning that many more bulls to bears. We'll break down the data here on this next one so you can see it individually. So this is how it sorts out, and this is where you get the ratio from. You know, they just do it. This is just a percentage of the percentage of respondents. We've seen bulls go from 50% of them were bullish down to 42% just in that 2-week period during the heaviest parts of the correction. I should add that your tell that the market was due for a correction was that bulls was up at 60% in late September. So that encouraged me to stay cautious and have some short positions because exuberance was a little bit too high. All the newsletter writers, 60% bulls, and that was just too high. It needed to come down. It has come down. Has it come down enough? So let's go back and look at the data here. The one thing that hasn't moved, though, is the bears. Lost my cursor here, but that's all right. The bears, you can see, hovers just below 20%. Why? Because, let me just show you one other thing. So we want to see these blue and red lines converge a little bit more. We don't need to see it pull an action like, here's my cursor. So we don't need to see this like we did during the 2015-2016 earnings recession where it inverts and we have more bears than bulls. We don't need to see that. But we do need to see them get a little closer. So the question is how low could bulls go? Could it go below 40%? I think it should, to wash out some of the bullishness and get people bearish. And this bearishness could rise. It really hasn't risen that much. Look at it's done nothing but go down. This should go over 20%. And the reason it's not is the next one I'm going to show you is the correction camp. This is also a part of the Investors Intelligence Survey. They ask, how many of you are calling for a correction? And this was down at 20% and has risen to 37.7% as of November 6th. So what that tells you is, that tells you why the bears ratio or the bear percentage was so low, under 20%, is because those newsletter writers didn't go full bearish. What they said is, I'm moving to the correction camp. We're going to have a correction. So they can't be in both at once. So you've got all these guys move over to the correction camp. And that means they're just short-term bearish. But what you really want to see is for more of them to become, longer-term bearish, like, whoa, and start talking the R word, recession, right? Which is kind of what fund managers have to worry about. I showed you the fund manager data earlier. They have to think out 6 to 12 months. When is the R word going to happen? Now we need to see the newsletter writers and the retail sentiment shift towards that. And so the correction camp, that could easily shoot above 40%. So that's what I want to see for a real bottom here in November and we may get that data. I mean, that may be the data we see this week. Correction camp goes over 40%, bulls goes under 40%. Or maybe more people shift to bears. But I want to throw in here Jim Paulson, who is now with the Luthold Group, and he's saying the same thing the other day on Squawk Box, that he doesn't think that fund managers are as bearish as they're going to get, because you're not hearing the R word on their lips very much. Once they start talking more of that, and then that's when you're going to find a bottom in stocks. And he thinks that's S&P 2400, more fair value. As earnings estimates need to come down too. That's the other thing, is earnings estimates. We've been talking about this and many episodes of Cook's Kitchen. They haven't come down enough. They're still above 170 for next year. And if that's bottom up, maybe there's little justification for that. So if that comes down to, say, 160, that's where he says, hey, that's where you buy the market. 15 times 160 is 2,400. I don't see 2,400 right now on the radar, but it is possible. Okay, that's all I had for you. So I think that in the market right now, today, is finally tapping on that S&P 2,700. Cannot get a sustained rally going over 2,750. So we have some work to do. Go down, test 2,650. I think if it breaks 2,650, it puts in the Feb correction lows at S&P 2532. I think that puts those in target. And then if we go down below 2,600, then we can start talking about the probability of S&P 2400, which seems remote right now. So I gave you sentiment, confidence and optimism from three different parts of the market and the economy. The consumers and small businesses, soaring optimism and confidence, and I think that's your long-term view. I think that tells you that, hey, the economy still looks good for the next 12 months based on leading economic indicators and small business consumer confidence. In the short term, we want to see these newsletter writers get more bearish and capitulate. And then in the medium term, you have large investors who are having lots of macro angst, beginning to raise their recession probabilities as the global recession could spill over onto our shores. And so medium term, when they sort of have a capitulation and wring out that fear, take down the FANG stock some more, then we'll have a turn, because then the market will be more fairly valued for them, and there'll be aggressive buyers, under S&P 2600, and the market can turn and rally into the new year. All right, that's my outlook based on the #1 currency in the world. Thanks for joining me in the kitchen.